Hello, I'm Russell Poynton from Edison Group, and it's great to have with me again Richard Hutton, who's the CFO of Greggs. Thank you for joining us again, Richard.
My pleasure.
So let's go back to the results. I think there's a very clear message that you're giving that Greggs is outperforming a very challenging market, but also I think equally there's some surprise that you've got negative volumes, comping negative volumes, despite your value leadership. So can you just give some insight into what you think is happening in the market?
Yeah, no, it's been a tough year, and you're right. I mean, we've shown that we've grown market share over 2025, but it was a market that, measured in transaction volumes, went backwards 3% over the year. So it was a tough environment. We've been both growing the Greggs footprint, but also actually taking share on a more like-for-like basis as well. So there's been a lot of conversation, I guess, about what is it that's driving it. There are various factors in there. I think the biggest one of all is economic, in terms of just the lack of confidence in consumers to spend, and I think that's backed up by the fact that what we've seen is a lack of footfall as well. It's not simply eating behaviours or patterns in diets, although there may be some of that. We think the biggest factor out there has been footfall. Some of it very short term in terms of things like the heat waves last summer, but more generally, there's just been a slightly slow economy, and despite people progressively having a bit more money to spend, there's been a lack of confidence to go out and do that.
And a phrase that has been heard quite a lot in the last year or so is peak Greggs. And as you were saying earlier, I think we first heard that from the previous CEO 5 years ago, just to say not peak Greggs yet. It obviously comes against a background where you do have soft volume. So perhaps be interesting to find out why you think you're not peak Greggs.
Very confident that this peak Greggs is a long way off. Essentially, I mean, the challenge has been, are you sure, Greggs, that you're not cannibalizing your own shop sales by just expanding a bit too much? We can be super confident in this because we can measure the behavior of consumers that use our app. And we did some studies last year which showed on a very big sample basis that consumers who use our new shops maintain the frequency at which they use the existing store portfolio, but they add additional visits to the new shops. And that's because the majority of the new shops are expanding us into areas where we're currently very underpenetrated, and they're on a very different mission. So the traditional customer who might be on foot around a high street where we traditionally traded, they're still doing that, but there are occasions when they're in their car because they're either on a journey or they're going to the supermarket or they're at a retail park, places like that where traditionally you couldn't find a Greggs. Now we're starting to pop up. And that's a different occasion, it's a different mission, and we're showing that we can build frequency by being more penetrated in those areas. And that's the basis for the next level of expansion in the Greggs estate.
And you're continuing to grow the estate, but at slightly slower rates than you previously intended. So it'd be interesting in your thoughts, because one focus is to actually maintain returns whilst the environment's tough, but the other view could be, well, if you are taking share, the market's challenging for your competitors, why not actually put the foot on the gas and open more stores and take even more market share?
Yeah, no, you could take more stores, but we've always been very disciplined about capital investment and the returns that we make on that. So there's a very well established process that goes on within Greggs when we're looking at new shop opportunities and filtering out those that are not right for us. Last year we added a net 120 stores on that basis, i.e. those were the stores that came through the filtration process and made it over the line. And that process determines the number. So people are asking me how many shops this year, Richard. I'm saying, well, probably about 120. But the reality is I don't know, because it will just depend on how many come through that assessment process. And I think that's the right way to approach this, so that you are getting good shops and making sure that you're not filling up your capacity just because it's available. You're filling them up with good shops, and depending on how many of those, you'll reach the next investment point either sooner or later. But it's clear from the white space review we've done and the level of penetration we have that there are plenty of good opportunities up there. They just come along at a certain pace, and it's important that you don't just jump to hit a number. You always kind of take the right number based on the investment criteria.
And how much of that is driven by external third parties in terms of, whether their pipeline has slowed down a bit, so there's fewer coming to you?
There is a little bit about investment because obviously kind of landlords are having sometimes, particularly on the new builds, they're having to invest themselves, and the pace of that can change, so that can be a factor. Equally with franchise partners, depending on the circumstances that they're finding themselves in, they may be investing in, more or fewer, say, garage forecourts, those sort of locations. So, we're working in partnership with these people, and again, it's right that we go at the pace that good opportunities come up, not a predetermined pace.
Yeah. And against that challenging market last year, you actually got some efficiency savings out of the business to help the profits. So perhaps be useful to find out where those efficiencies came from and how much more there is to come in the coming year if it is going to be a slightly challenging year again.
Yeah, no, it's an ongoing program. We challenge ourselves in the business to constantly try and find, I guess, costs that we can structurally change within the business, because there are always new things coming in that we either have to or want to spend money on. So you have to be looking at the costs and the things that you just don't need anymore. Very often it comes from working on what we'd call an end-to-end process review. And because we're vertically integrated, all the way through from bringing ingredients into our manufacturing sites and products through the distribution chain, all the way through to the shops, there are often opportunities in the way that we handle goods through the system, the amount of packaging or waste that's involved along the way. And we basically work very hard to try and sort of minimize that. Some of it comes into our shop operations because, small differences can make a big impact when you multiply them by the number of transactions we handle every week. So, for example, investment in new till systems that work faster, give the customer a better experience, but the transaction itself speeds up. And when you multiply that by X million a week, these small marginal gains add up. So it's looking at all sort of aspects of the business and trying to say, how do we kind of make the business more efficient without affecting what the customer gets, hopefully making that experience better in the process.
And slightly out of a tangent to that is the capex numbers that you've guided to for the coming years. They're slightly lower than what you indicated a few years ago. Peak capex is just behind you now. So what are the reasons for that slightly lower capital spend going forward?
There's a few things. I mean, we've been looking very hard at that and trying to, I suppose, typically when we guide, we are slightly conservative. We've probably been less so and said, look, we've committed a lot of capex to this next investment phase. We do need to make sure that we're running things as lean as we can over the coming years, because we want to see the return on capital in the business return to where it was, which was around a 20% ROCE. And we think that's a sensible ongoing sort of level to target for the business. And, controlling capex well and making sure you're getting great returns on what you spend is all part of that. Some of it is good work that's been done on procurement. Some of it is the phasing of the refit program. And we found that the last refit program that we put in place for the estate is proving to have good life in it. And so, in a couple of years' time, we will need to increase the pace of these refits. But it's been quite good to be able to sort of just moderate those a little at the time when we've been going through what was peak capex year last year. And as you say, it comes down significantly this year and again next year, which is reducing the kind of the capital and cash requirement on the business.
And for the coming year, you're guiding to limited profit growth in the absence of a consumer recovery. Feels quite tricky out there at the moment.
Yeah.
So what's the key things that you're looking for a slightly better consumer?
Yeah, I guess it's confidence, to some degree. We may see a weather bounce because we did have this very hot spell last year, but who knows? Maybe it'll happen again this year. We shall see. But essentially, it's really about consumers feeling a bit more confident to be out there and spending money. Because very often we're not the primary reason they're out. We're feeding them while they're out and about doing other things. Whether it's working or leisure or out shopping, that sort of thing. So it's activity in the economy fundamentally. We can make some of our own luck in that respect by the work that we do on product development and some of the sort of the activity that we do to highlight what we're doing, and we'll continue to do that to the best of our abilities. But there's also an economic backdrop to this.
And a month or so ago, you felt relatively happy about the outlook for input costs over the coming the coming year. I suspect what's happened in the last few weeks might have changed that a little bit. So perhaps worth talking about where you think the inflationary pressures may come, but equally you're quite well hedged on a number of costs. So perhaps worth giving an update on where that protection is.
Yeah, I mean, there we were at the start of March, really sort of saying that we thought actually inflation was coming our way, but of course things were starting to move geopolitically. Here we are now, sort of tipping in towards April, and we've got a very different outlook. But we've got about 4 months forward cover in terms of the ingredients and packaging that we bring into the business. So really, it's an H2 exposure if there is more inflation in food and packaging. We're very well covered on electricity, which is the bulk of our energy requirements. So we're 100% covered for 2025. We're already in 6, of course, and we're half covered for 27 as well. So that's a pretty good place to be. So I think if there is more inflation coming, it'll be H2 weighted, and we will probably have to move prices a little more in response to that. But we have the scope to do that within our plans for the balance of the year.
Good. And the topic du jour for any food or beverage company at the moment is GLP-1s. Now, at the start of the year, Rasheen got some headlines by saying there's been some minor effect on the business. So I'd be interested to hear about, one, how you looked at that, how you determined what effect there had been, and then potentially, do you think it's a big risk for Greggs, or do you think it's a good opportunity for Greggs in the medium term?
Yeah, I mean, the reality is nobody knows how to quantify this because it's hidden in amongst all the other things that you're doing, and all the other kind of economic impacts on the business, and it's very hard to pull anything out. But it would seem odd to be sitting here saying no, this won't affect us. That would be madness. So there must be some impact on the food industry overall, and I think Greggs will be part of that. So we can't really pin it down to anything specific other than we don't want to be seen as deniers. But we genuinely feel that the bigger factor is the kind of the macroeconomic position and consumers' reluctance to spend. But we are responding to a broader dietary change that we've seen over a number of years, actually, and it's not just since GLP-1s. I think even leading into this period, people were already starting to make choices which involved more protein, for example. And we'd seen this in our own sales mix and seen that things that were becoming popular in the market, such as sort of chicken goujons, those sort of things, were selling really well when we introduced them. So we've continued to back those sort of product lines. They continue to go well. We've introduced other options in terms of snacking egg pots and protein shakes and Plenish shots, which all lean into the idea that if people are eating differently, and I put it that way rather than necessarily less, because I think there's only a small number that are eating less, then there's a broader number who are changing the way they eat and changing their diet, and that is something we can follow, and we always have done. Greggs has been successful over decades because it's followed food trends. So once we were the bakers who sold bread and rolls. We don't do that anymore. The whole brand has followed market trends, and this is another one that we will absolutely follow. So you'll see products coming in through this year which lean into that, but they need to have broad appeal as well. There's no point in trying to just launch things for particular people on particular diets. So we've just got half baguettes in the store this year, and in a trial basis to see what happens. And the early evidence is that they're popular with some people, but also others want to bundle them with other food items. So if you like having potato wedges with your sandwich, it's easier to accommodate a half a baguette with potato wedges than is a whole one. So it's interesting, and sometimes that sort of stimulus makes you innovate in a positive way. But it's great if it has broader appeal, because it's much more sustainable than trying to run something for a very small part of the population. So that was a long way of saying, I have a lot of faith that Greggs will evolve its range to follow whatever trends the market throws at us. That's what keeps us new and interesting over the years and keeps customers coming back.
Good. Well, Richard, we seem to cover a lot of varied subjects there. So thank you very much, and good luck with the coming year.
Thanks, Russell.